Hello and welcome to The Upside. I'm Jordan Chevalier. U.S. equities continue to hold strong amid the ongoing U.S. federal government shutdown, and with earnings season around the corner, what might the end of 2025 and Q1 2026 have in store for the markets? Joining us today to share her thoughts on the U.S. government shutdown, interest rates, and the latest in the valuation story is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Denise, it's great to see you.
Hey, it's great to be back, Jordan.
Let's start with the government shutdown in the U.S. We have got a couple questions coming in. What exactly does that mean, a federal U.S. government shutdown?
Yeah, it means all non-essential government work essentially halts.
Okay.
And many people are sent home from their jobs, and like furloughed is the coin of the phrase, which means that a lot of government employees are going without pay right now. Usually what happens, in fact, 100% of the time this has happened in the past, you do get back pay as a government employee. I was actually part of a government shutdown when I worked as a government contractor in the 90s, and I did, in fact, receive back pay during that time. But this has happened around 20 times when you go with the data back to the 1970s. And the interesting part is most of them last just hours. And there were about 5 or so instances, which, if you sort of couple them together, have lasted 15 days or longer.
Okay.
Now, you would think that that is a long time to shut down a government, and that
Definitely.
must have an impact on earnings or the economy. But when you study the historical trend, it really doesn't. It doesn't impact industrial production, it doesn't impact GDP, and it doesn't impact earnings. And because of that, from a long term perspective, you see very little impact on stock markets, which is essentially what you're seeing right now.
So you think is there anything different about this time? Anything different about this period, or maybe if the length is different? Do you see that changing, or you think there's the data that suggests that this is sort of similar to what's happened in the past?
Yeah, the length is always very variable,
Right.
right? The longest we've seen historically is about 35 days, which again, over a month, that seems like a long time. Length in and of itself hasn't been enough of a shock to the US economy to matter that much to, again, GDP, earnings, or anything that drives the equity market. What could be different this time is that this administration has said, well, maybe instead of giving back pay this time, we won't.
Mhm.
Or maybe instead of hiring workers back, we won't. Now, again, we'll see how this all plays out if these are just political threats, which is something of what you see in a government shutdown. But even if you look at that in terms of the federal workforce, we can go back to those austerity measures we saw in 2012, where the federal workforce shrank by 5%. Which was an epic amount relative to history. I mean, we saw something like it in the 1990s, and even that seems like a whole lot and it would have a lot of impact. But when you add it all up, as much as there's idiosyncratic problems for certainly all those workers involved, it's usually not enough to move the needle as it relates to the economy. And therefore, while it seems, slightly insensitive, stocks tend to look through the noise to the bigger driver, which tends to be earnings, which right now are going up.
And another driver that we're seeing is, of course, interest rates. Can you talk about your view overall about the Fed's direction with interest rates right now in the US?
Yeah, so let's go to the data. I think that there's two debates about the Fed. One is that the Fed should have been lowering interest rates already, has committed a policy mistake because of the soft labor market. So we'll
Right.
take that as sort of one side of the argument.
Okay.
The other side of the argument is, look, we just entered, GDP of 3.9% on a quarter-on-quarter basis. The economy is still strong. To the extent that the Fed reduces interest rates too much, that might reignite inflation. So let's take those two and look at the historical data and see if we can make sense out of either argument. The interesting part from my vantage point is that when I look at the historical data about real interest rates, the higher real interest rates have been, the more likely GDP is to grow over the next year. So, as much as we think all else equal that there are these lagged impacts to monetary policy, what I see in the data is more often than not, which is not to say every time,
Mhm.
the Fed actually follows the cycle rather than creates it. So if you tell me this time that the Fed seems like they're a little bit late and that employment has been a little bit soft and they should have been cutting earlier, I don't see that particularly different from history. And I don't see it particularly problematic right now because we have a whole lot of leading indicators like corporate profits that I was just talking about, that do suggest that the soft patch we're seeing in employment might actually be better as we go through the course of the year. On the other side of the argument, I think, is this potentially reignition of inflation on the other side if they lower interest rates too much. For me, when you look at the core CPI and you strip out shelter, which is its own lagged component, our core CPI ex shelter has been running around 2%. This is even with the tariff impact that we've seen. So you're not seeing a broad-based rise in the generalized price level. You are certainly seeing some rises in some good prices that have tariffs accompanied with them, but you're not seeing broad-based inflation. Inflation, when I look through history, is just a whole lot harder to get than you would think. I mean, look at Japan all these years later. So it's not just stimulative monetary policy that ignites inflation. In fact, there's not a historical relationship between interest rates and inflation, ironically speaking. So I don't think that the Fed is in policy mistake territory right now. And I don't think that we're in danger of reigniting inflation, which puts us in the sweet spot for equity market returns.
Denise, you briefly mentioned tariffs there. I'd like to spend a little more time on that. When you were on the show last month, we talked about how much or how little the market has priced in these tariffs. Has there been anything that you've seen since the last time we spoke that would indicate a shift in that tariff pricing?
Yeah, not really. I mean, I think that the irony of it all is that peak uncertainty was, in fact, a buying opportunity, as it suggests in the data, meaning that, yes, it was uncertain. Things are still uncertain in terms of how it will play out. People are still arguing about who is bearing the brunt of the tariff increases. And there are some arguments, 60% is borne by the consumer. Maybe it's only 40%. Does the foreign producer bear some? We're still not sure, and we'll have to sort of sift through all the data on that. But what is very clear is that it's being absorbed, right? And we are most of the way through of the impact of tariffs. It's been dragged out longer than we thought, which means it's less of a shock to income than I think the Fed thought, and less of a shock to CPI than the Fed thought, which is sort of back to the Fed. One of the reasons I think that they're lowering interest rates is because they can, not because they must, because employment is so weak, because despite tariffs, inflation is still coming in about, in line or potentially even a little bit lower than they expected, especially when we started the year with the tariff announcements. So that gets to this renormalization of monetary policy at the same time that tariffs appear to being absorbed without a shock to the US consumer. The real consumption growth is hanging in pretty well. Real income growth is also hanging in pretty well, which means that the consumer is in good shape in aggregate, despite the impact of the tariffs.
Looking now to valuations, is there anything to suggest that these higher valuations continuing long term, is that just a net positive when you look at overall markets and the investors, or is there a little bit of nuance there within that valuation story?
I'll just generally be the naysayer on valuations in the sense that when you just study the data, I really have a hard time finding anything predictive about it. So when you quartile it out, you say from the cheapest quartile to the most expensive quartile, what are my go forward odds of a market advance? The market goes up 75% of the time, regardless of valuation, right? So we can think about, valuation. It makes sense to say that it should impact your risk reward. But when I look at long-term history, I can't prove it at all. And in fact, sometimes you prove the opposite, meaning that if the stock market goes up a lot, you can see in your crystal ball that once the market goes up, it usually goes up, right? A ball in motion stays in motion. This is why momentum is actually a factor. So you say, okay, well, wait a minute. What if your starting point is really expensive? Well, then it would make sense that you go up less, right? Wrong. You actually go up more and more often. So what you find is valuation, as much as we think it might mitigate your future returns, what you find is it's almost a measure of confidence and almost like stocks get it right. Because if valuation expands ahead of time, it usually means that mid-cycle earnings are actually just stronger than you think because stocks move in advance of earnings.
Right.
So sometimes valuation is just an expression of confidence in those earnings that you see are more durable. And I think that there's a real reason for that this cycle. And it's around the tax cuts that we've seen in the US, which total about 700 basis points of effective tax cuts between sort of bonus depreciation and that R&D expensing. You add that on top of the fact that the Federal Reserve is renormalizing rates because they can, not because they have to. And all of a sudden, median earnings growth, which is now starting to inflect higher, looks a whole lot more durable. So the stock market isn't going to wait for that durability to be evidenced. It's actually going to price it in ahead of time, which is usually what the stock market does. So hence you're seeing this valuation expansion, which to me, again, quantitatively, I don't find it problematic. And in some ways, all of those mantras we've seen about higher for longer in terms of inflation and the Fed, I think we got to get used to the higher for longer of valuations as well, especially in the US.
Denise, let's look now a little more closely on some specific sectors. I want to talk about energy and then gold. Let's start with energy. What are your thoughts right now on energy? What are you seeing? What is the data supporting there with that sector?
Yeah, I find energy a problematic sector, and it's mainly around the fact that fundamentals just aren't in a position to be meaningfully good. So, energy is a tricky sector in that it is very cyclical, meaning that there's not a secular uptrend like you see in technology where companies have just gotten more and more profitable cycle to cycle. So, what you usually just see is this very steady arc towards a median profitability. Now, 2022 was the most profitable this sector has ever been in my data set going back to the 1960s. We're still renormalizing from that. Now you add on to that this means that energy is probably still in a low earnings growth situation, especially relative to other sectors that are growing like technology. So relative is even worse. But energy is one of the only sectors, and this is a little quantity, but hang with me for a second, where you get trough multiples on trough earnings. A lot of the times when stock earnings fall out of bed in a recession or at the bottom of a cycle, you usually get this valuation expansion, which makes the stocks actually appear oddly expensive. But that's just because earnings are artificially low. Well, energy is the only cycle where investors don't wait for that. They don't cushion that blow. And you usually get multiple contractions, so the stocks are valued less on those trough earnings, which makes energy dangerous to play in terms of being early because there's more downside in energy statistically than most other cyclical sectors. So that makes energy, I think, a tricky situation, despite we can debate, excess supply and all of the other geopolitical risk premium potentially coming out of it. So it's really just the fundamentals I don't think are in good shape to lead to outperformance. Gold, on the other hand, is the commodity with a much better supply and demand dynamic. Now, what you see in the commodity is, again, of all the commodities you look at, that is the commodity, both in a long-term uptrend, which is important, and two, one of the best supply and demand dynamics because of the buying of central banks, right? You don't see that structural demand really anywhere else, and you're seeing more buying over this last 5-year period than, I don't want to say than any other 5-year period, but you're certainly seeing a secular trend.
Right.
I think it's a little more complicated to make this a function down, one click down in the equity market to buy the gold miners, since right now this isn't a problem because gold has gone up so much so fast, they have plenty of free cash flow. But these are companies that generally cycle to cycle look a lot like energy companies, where they usually burn through a lot of that profitability and free cash flow because it takes so much money to get it out of the ground. So I think gold as a commodity looks very interesting still, even though it's up a lot. I'm sure you're likely to see a shakeout, but still looks interesting from a supply-demand dynamic. But I think that gold miners is a little bit trickier when you think about equity relatives. I still prefer things like technology, financials, and consumer discretionary versus any of the miners.
Denise, thank you for sharing those insights. Gold was the top question that we've received coming in from viewers. So very, very happy that you're able to address that. Looking now to next year, are there sectors to watch towards sort of the end of Q4 here, 2025, or looking to the first half of 2026? Things that are on your radar, opportunities or sectors to watch. Let's end there.
Yeah, I think one of the things that I am going to be watching is CapEx in technology. So that is one of the big sort of trends that people are talking about in AI. Are these CapEx numbers too big? I think that they're eye-popping when you think of them on a nominal basis, but there is also eye-popping free cash flow. So you always have to rescale them. That's why I look at either CapEx relative to sales or CapEx relative to free cash flow for the technology sector to see if it really is impactful or growing above average or in that way that looks anomalous. Right now, when I look at the data, oddly enough, CapEx relative to sales for the technology sector is right in the median level of history, meaning that as much as people are saying we are spending so much money on AI, for this aggregate sector, they have the cash and they have the sales to be able to spend. So I am keeping my eye on that data set for any kind of anomalies, but I'm not seeing anything yet.
Denise, thanks so much again for joining us and sharing your key market insights and all the data research. We really appreciate it, and we'll see you next month.
Absolutely. Great to be here.
Thanks for watching, everyone. Just a quick reminder that Upside webcasts air daily, so keep an eye in your inbox so you don't miss an invitation to the next show. And if you haven't done so already, sign up for the Upside newsletter to make sure that you don't miss out. Also, video podcasts are released frequently, both the Upside and Fidelity Connects. Just search Fidelity Canada on YouTube, Spotify, and Apple Podcasts. Thanks for joining, and I hope you'll join us again on the Upside. I'm Jordan Chevalier.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.